tensions in the Middle East are putting upward pressure on commodity prices, specifically oil. All eyes are on the Iran war and what happens next. The conflict is causing some investors to rethink their positions. Hello, everyone. Welcome to the program. I'm Stephanie Stanton. It's great to have you with us. Be sure to subscribe to ETF Guide TV and post your thoughts in our YouTube comment section below. All right, we continue on now with a closer look at the energy sector and how investors can protect themselves during this tense time in geopolitics. Joining us now is Paul Baiocchi, CFA, Head of Fund Sales and Strategy with SS&C ALPS Advisors. Hi, Paul. It's great to see you.
Great to see you as well, Stephanie.
So much to talk about today. Let's begin with the tensions in the Middle East, obviously putting that upward pressure on commodity prices. How is USCF SummerHaven Dynamic Commodity Strategy, no K1 fund ticker, that ticker SDCI, how is that positioned to benefit from the geopolitical risk premium?
The methodology of SDCI is unique among commodity strategies. It's dynamic. It changes on a monthly basis based on the shape of each individual commodity's term structure in the universe. And we can dig into that in a second. But at a high level, most commodities benchmarks are just heavily weighted towards energy commodities. They're production weighted with maybe in a liquidity screen, and they tend to be dominated by energy commodities. So your typical commodities benchmark has benefited from this surge we've seen in WTI and Brent crude and gasoline prices. But SDCI is different because on a monthly basis, it's looking at the shape of each commodities curve. And what that means in simple terms is that those commodities who are in backwardation tend to get a better rating in that index methodology. Those that are in contango get a worse rating. Oil, natural gas, most energy commodities are typically in contango, but during this Iran conflict, we've seen WTI and Brent crude prices heavily backwarded, meaning future prices are significantly lower than the spot price. And that means that if you look under the hood of SDCI at the moment, it does atypically have a lot of exposure to gasoline, to WTI, to natural gas, to those energy commodities. So by virtue of its methodology and by the design of SDCI's underlying index, it does move towards commodities whose futures markets are representing a near-term imbalance between supply and demand. So at a moment where you've got this geopolitical uncertainty and a geopolitical risk premium in the price of, say, crude oil globally, it does tend to mean that SDCI is going to have exposure to that commodity, but it doesn't necessarily mean that it's going to have exposure to that commodity if the market curve in WTI or Brent crude or some of these individual energy commodities normalizes a bit. But importantly, this is also revealing of the knife's edge that global commodities markets live on. And geopolitical uncertainty always adds a premium to price in various commodities, but it's particularly acute at the moment in the energy market.
Yeah, that makes total sense. When we talk about the energy crisis, how is it impacting Alerian MLP ETF? And the ticker there for our viewers is AMLP. And also the Alerian Energy Infrastructure ETF, that ticker is ENFR.
Well, we did see really strong performance from the energy sector. In fact, so far year to date, energy is the best performing sector in the S&P 500 by a very wide margin. AMLP has participated in it, as has ENFR in the rally in energy prices or in the rally in the energy sector. But what's unique about AMLP and ENFR is they're very much fee-based businesses, meaning they don't have as much leverage to the price of crude oil or the price of gasoline because the fee-based nature of the business is much more consistent. So you're never going to have typically in a market like this full exposure to a rip your face off rally in energy stocks and in energy prices. But because this is a very domestically oriented segment of the energy sector, these companies own assets in North America. They're not as exposed to disruptions in, say, the Strait of Hormuz and the supply constraints that come with it by virtue of the fact that most of these pipelines and energy infrastructure assets are located here in the United States. The other piece that's gotten lost in the headlines around oil is the impact to LNG globally. And of course, that massive facility in Qatar, which is very centralized, was hit by some Iranian missiles and drones, and that has put pressure on global LNG prices. Within the energy infrastructure segment, some of the companies that are liquefying natural gas or in the liquefaction segment or preparing natural gas produced domestically or in North America for export have actually seen some tailwinds as a result of maybe some increasing or improved prospects for participation in global LNG markets going forward. So in many ways, it's done. AMLP and ENFR, when I say it, has done exactly what you would expect in terms of providing perhaps less participation in an upside rally in energy, but also consistent, stable exposure to the energy sector.
Yeah, I mean, they're saying it could be, 5 years before that facility is back up and running to its normal capacity. And you're absolutely right, because people forget about the LNG market, because it's always the focus is on oil, but the LNG problem is a big one. All right, let's shift gears, talking about electricity, because this conflict in the Middle East is definitely sharpening the focus on energy security at the exact moment when electricity demand is also accelerating. In your opinion, where does renewable energy fit into this picture?
One of the winners coming out of a conflict like this could and will likely be renewable energy, because if you think about it, building wind farms, building solar farms, building batteries or storage to bolt on to those high latency energy sources and electricity sources is something that is expensive in a vacuum to build, to outlay. But once they're in, they're not beholden to the global supply and demand dynamics of traditional fossil fuels. And so in some ways, countries are accelerating their budgets and their investment in renewable energy sources as a way to offset their exposure and their economic sensitivity to these very concentrated sources of fossil fuels. You've seen countries already take steps to diversify their energy mix toward renewables, certainly famously in developed markets. And in the United States, we've made great progress in integrating wind and solar, and more recently storage, into the calculus of our electricity generation. And I think that's going to accelerate coming out of the conflict in Iran whenever it ends, if it ends, because countries are waking up to the realization that they're beholden to very unstable pockets of the globe as it relates to their crude oil needs and their natural gas needs. And if you think about the progress we've made domestically and globally in terms of adoption of wind, solar, renewables, hydro, you could put a number of different technologies in there. That has to continue apace to diversify the mix that goes into electricity generation at a time where electricity generation and electricity demand growth globally is exploding as a result of a number of different drivers. And ACES, as an example, gives you texture exposure to all of these emerging technologies in that renewable energy segment.
Right. And ACES, of course, is your ALPS Clean Energy ETF, that ticker ACES, ACES. We also have the USCF Sustainable Battery Metals Strategy Fund, and your ticker is ZSB. So as you were talking about ACES, break it down for us. Tell us how these types of funds can actually be appealing to investors.
Yeah, so what ACES tries to do is capture all of the companies, North America focused, that operate in 7 different segments of the renewable energy sector. So you think about everything from wind to solar to storage, which is batteries, as well as hydro and geothermal. And so ideally, you're mixing and matching all of these emerging technologies and capturing the companies at the forefront of that innovation. ZSB is unique in that it allows you to drill down to the raw materials that go into storage specifically. And last year was a record for enterprise level battery installations. The year prior was another record in terms of battery installations at an enterprise level. And we're seeing massive demand for batteries. We're seeing significant projections around the growth and adoption of batteries and enterprise level storage, not domestically, but globally. And the metals that go into this, think about things like copper, nickel, aluminum, silver, as well as lithium, have contracts that are traded in futures markets on those commodities. And ZSB targets those specific inputs, which are constrained globally by virtue of supply chains or where they're located or where the supply chain exists, and gives you exposure to what is going to be a big part of not just the energy transition, but of this ability of various countries around the world to realize these massive ambitions that they have in terms of increasing electricity demand, increasing electricity transmission, and storage is a big part of that. And therefore the inputs that go into those batteries are critical as well.
Sector leadership in 2026, of course, looks very different from the earlier stages of the bull market. We are now seeing rotation away from some mega cap tech and into more cyclical and value-oriented areas. How does ALPS equal sector weight ETF, and your ticker there is EQL, equal weight by sector approach? How does it help investors navigate this rotation?
Well, I think most people came into the year, if you look at a lot of the home office research, buy side, sell side research, we're expecting the market to broaden out. At this point in the bull market, you need a little bit more breadth. So much of the bull market to date, going back to 2022, has been dominated by communication services, technology, consumer discretionary, really where the Mag 7s sit. And as you expect the market to broaden out, you expect perhaps other sectors to participate in the rally. And many people's knee-jerk reaction is, well, instead of just buying the S&P 500, which of course is famously market cap weighted and has concentration in those sectors and in those companies, I'm just going to equally weight all of the stocks in the S&P 500. And we feel that that is effectively trading one risk, concentration, for increased volatility, and doesn't necessarily achieve the objective of trying to play that broadening out theme. And so if you look at year-to-date performance in the S&P 500, it's energy, it's materials, it's utilities that are leadership so far, sectors that have or add up to less than 10% of the S&P 500 by weight. So EQL takes all the 11 GIC sectors of the market, equally weights them, underweights the sectors that dominate the S&P 500 by weight, and increase exposure to sectors that have very small weightings in the S&P 500. And if that broadening out is a result of underperformance from the dominant sectors in the market by virtue of slower earnings growth or concerns about AI, or if it's coming from, say, a geopolitical event like the Iran conflict, doesn't necessarily matter. But what matters is how your sector exposure plays out in the market in the moment. And with EQL, those sectors that it is overweight relative to the S&P 500 just happen to be in 2026 leadership sectors.
Yeah, you mentioned tech, you mentioned the Mag 7, you mentioned AI. I want to pivot back to electricity a little bit because we talked about that electricity demand, forecasting to grow at rates not seen in more than 50 years, driven in part by these AI data centers, also EVS, and industrial electrification. So how is ALPS Electrification Infrastructure ETF, and your ticker there is ELFY, how is it specifically designed to sort of capture these opportunities?
We're talking a lot about these near-term trends in the market, the geopolitical uncertainty, the rotation in the market for 2026. And the challenge for advisors in some ways is balancing near-term dynamics like that with big long-term secular trends. And in our minds, the biggest, most important secular trend in the market is what we call the electrification of everything, or increasing electricity demand. We're seeing forecasts for electricity demand growth that are at rates we haven't seen going back nearly 70 years. In fact, electricity demand growth was 0.4% on average on an annual basis. And depending on what you look at, it's expected to grow at 3.6% on an annual basis over the course of the next 10, 15, 20 years. And so ELFY was designed not just with that in mind, but also with the idea that when we got out of the Paris Accord, meaning we abandoned some of these net zero goals or commitments, a lot of the states, 29 plus states in the United States, created their own renewable portfolio standards, which required utilities in the United States to invest massively in renewable technology, in sunsetting coal, in sunsetting fossil fuel-based electricity generation. So you have this forced spending even before you're starting to see this convergence of new demand sources like AI data centers, like EVs, autonomous vehicles, heat pumps, induction stoves, as well as home robotics, enterprise robotics, automation of supply chains, reshoring of manufacturing, all of which are putting upward pressure on electricity demand. And so tying it back to ELFY, ELFY was designed to invest in the companies who stand to benefit from rising electricity demand, not the companies that are causing rising electricity demand. In fact, you already own a lot of the companies that cause rising electricity demand, whether it's the Mag 7 or the hyperscalers or the companies at the heart of that massive CapEx investment boom. ELFY is pulling from 5 different sectors, 18 different sub-industries, all of which are designed to be in companies whose goal, whose day-to-day business is providing the construction, the specialty contractors, laying the lines, investing in transmission, generation, providing the raw materials that go into building the electrification infrastructure necessary to support rising electricity demand. So in our mind, ELFY is a way to get textured exposure to the companies at the heart of electrification infrastructure across many sectors, as we talked about earlier, which you don't have a lot of exposure to in your market cap weighted portfolio. If you look at materials, energy, and utilities, 3 of the largest weightings in ELFY, they add up to less than 10% of the S&P 500 by weight. So it's inherently a diversification tool that at the same time allows you to play on this secular trend of this explosion in electricity demand growth that's coming at a time where all of these new demand sources are converging at a moment.
Yeah, it is such a smart strategy, which is why we love you, by the way, because a lot of people, they're thinking of the NVIDIAs, the Teslas, and they may not be focused on these support companies that you just mentioned, and those are equally as important. So, all right, well, we are going to leave it right there. Paul Baiocchi, always a pleasure to talk with you. Good luck with all of your ETFs, and we look forward to speaking to you again very soon.
Thanks so much, Stephanie.